Yes, good afternoon, students of CPA. This is your tutor, CPA Dunochoi. So it has been time since we met on our last live session, but now we have been doing online classes other than the live sessions, which I do one-on-ones. So we have been concentrating on the online classes, and that is why you find that I'm not doing that live classes from time to time. But today I've decided that we do this live session, at least we look at one of the areas in financial reporting and analysis, so that at least also you can be aware that our online classes are ongoing. The one which are done in the evening, that is 8 p.m. to 10 p.m. The one which are done in the evening from 8 p.m. to 10 p.m. So for today, I will be looking at published financial statements. So remember that we have various published financial statements presented by entities, that is involving the statement of profit or loss, statement of changes in equity, statement of financial position, and the cash flow statements. For today, I would like to look at cash flow statements. In this live session, I would like to look at cash flow statements. So, and to be more specific, for me to address the issue of cash flow statements, I will be doing the question for April 2025. Remember that now our next sitting is August. The sittings I have been preparing students for is August 2025. That is why I'm saying that online classes are ongoing. Other than these live sessions we do under YouTube, there's these online classes using Zoom platform. Using Zoom. So those classes we do in the evening. But today, let's look at least at our cash flow statements. That is April 2025, question 5. April 2025, question 5. So I will be able to read the question for a person who doesn't have that relevant question. What I can do, I will be able to share it later under the chat. I will be able to attach a link so that you can be able to access it. So I will be able to read it because I have a soft copy. So that question 5, it reads, so it's question 5B. Question 5B. It says that the following draft financial statements were extracted from the financial records of Bestway Limited as at 31st December 2024, with comparative for the year ended 31st December 2023. So you have 2024, 2023. So you are given a statement of financial position for the year ending 31st December 2020, 31st December 2024, and also we have that one for 31st December 2023. 31st December 2023. And meaning that the balances closing 2023 are at the opening for 2024, because our financial year for 2024 will be starting on 1st January 2024. So the closing balances here, closing balances for this are at the opening for this year, are the opening for the ending 31st December 2024. So we have the balances closing 2023 and the balances closing 2024. So when I will be saying balances brought forward, I mean the balances from 2023. Then balances carried down or carried forward are the balances as at 31st December 2024. Then you also have statement of profit or loss and other comprehensive incomes for the year ended 31st December 2024. Then there's an additional information whereby you are told that during the year ended 31st December 2024, motor vehicle with a cost of 5.26 with accumulated depreciation of 2.33 million was disposed for a cash proceeds of 4.02 million. The gain on disposal has been included in other operating incomes. So there is a motor vehicle which was costing 5.26 million with accumulated depreciation of 2.33 was disposed. It was disposed for a cash proceeds of 4.02. The gain on disposal has been included in other operating incomes. Number 2, Bestway Limited acquired new plants during the year ended 31st December 2024 at a cost of 3.6 million from a financing company. An arrangement was made at the date of acquisition for the liability for the plant to be settled by Bestway Limited, issuing at par a 10% loan note dated 2028 to the finance company. The value by which the loan note exceeded the liability for the plant was received from the finance company in cash. We'll be able to do the relevant accounting when we will be presenting the relevant cash flow. I'm just reading the question for now. Number 3, depreciation charged on property, plant, and equipment during the year was 10.98 and was included in the cost of sales. Number 4, intangible assets were amortized during the year, and amortization charged to the profit and loss amounted to 1.08. Number 5, during the year ended 31st December 2024, Bestway Limited made a bonus issue of ordinary shares of 1 new share for every 10 shares held utilizing the share premium account. So required statement of cash flows for Bestway Limited for the year ended 31st December 2024 using indirect method in accordance with the IS7 statements of cash flow. It's good I share this question under the chart so that you can be able to access it. For the students who have joined this live session, let me share this question under the chat so that when I will be presenting it, it will be easier for you to follow. This is a FAR, April 2025. Yes. I don't have enough space. Let me share it, then we start doing. So I will be sharing a link. Sharing. A copy. There we go. So for the guys following, if you check under the chart, there's that link I have shared. That link, you can use it to access that past paper. Use it to access that past paper. Use the relevant link to access that relevant past paper. And so we can do the presentation. So already I've shared the relevant past paper under the chart. So here it's called Bestway. The company is called Bestway Limited. It's called Bestway Limited. The company is called Bestway Limited. So they need a statement of cash flow. Statement of what? Statement of cash flow. Statement of cash flows, that is for the year. That is for the year ended when? For the year ended 31st December 2024. For the year ended that period. So you have shillings in thousands. I think our question was in thousands. And shillings in thousands. And then you have shillings in thousands. So shillings in thousands and shillings in thousands. So we start with operating activities. Obvious, when you are representing your cash flow statements, you start with the cash flow. Cash flows from where? From operating activities. Cash flows from operating what? Activities. So the cash flows from operating activities. Whereby you start from the profit before tax. You start from the profit before tax. So if you go to your income statement, that is the statement of profit or loss. You are provided with that profit before tax. So the profit before tax is all about 16,780. The profit before tax. So now you will be able to adjust this profit. Adjustments are made. So make some adjustments. So when you are making some adjustments for this one, when you are doing adjustments, so remember that for you to get the profit before tax, and there's an income statement given whereby we have some revenue, less cost of sales. Less cost of sales. Once we have deducted cost of sales, we have added some incomes. Add incomes, less expenses. Less expense, some expenses. You deduct some what? Expenses. So, on this case, there is both the operating and non-operating incomes and expenses. Operating, and we have non-operating, which have been adjusted. So we have operating and non-operating incomes and expenses, which have been adjusted, which have been put into consideration for us to arrive at the profit before tax. So what you need to adjust here against the profit before tax are those non-operating incomes and expenses. The non-operating incomes and what? Expenses. So you will come and mention a few, even without checking in your question if they are present. I will just come and mention a few, which you are supposed to know that they might be in a question automatically, and those are the ones you always check in the question. So I will just come here and say, depreciation is one of it. I know that depreciation is one of the non-operating or non-cash flow item. I will talk about amortization. I will talk about gain on disposal. I will talk about gain on disposal. I will talk about loss on disposal. Those are the ones I will just write before even I check in my question if they are present. Once I mention this, I will go back to my question. I will embark on my question and check, is there depreciation? Is there amortization? Is there gain on disposal? Is there loss on disposal? Before I go back to my income statement to pick the one which are given direct. Remember, these ones might be under the additional what? Information. That is why I have just mentioned them without checking the statement. So was there depreciation? Was there amortization? Gain on disposal, loss on disposal? Loss on disposal? Loss on disposal. If I go back to my question, under the additional information, number one, under the additional information number 1, they said that during the year ended 31st December 2024, motor vehicle with a cost of 5.26 with accumulated depreciation of 2.33 was disposed for a cash proceeds of 4.02. The gain on disposal has been included in other operating income. So it has been included in other operating what? Income. Whereby it's not supposed to be included there. We need to adjust it. So on that case, I will come and draw what? My disposal account. Because that one now, there's disposal. I've just started with additional information number 1. So disposal account, there's a cost. The cost is 52 what? 52.60. Then accumulated depreciation, the accumulated depreciation of that relevant plant, which was that what? Of the relevant motor vehicle, which was disposed, is 2.33. That is 23.30. 23.30. The proceeds here, the proceeds is 4,020 shillings. But now our statement is presented in thousands. So that the gain will be, let me pick my calculator. The gain, 23.30 plus 40.20. That is 63 what? This is 63.50. So here, for us to have 63.50 here, there is a gain, which is our balancing figure. A gain of 1090. So the gain of 1090. They said it has been included in other operating incomes. So we need to adjust it here. 1090. That is our first item. So it was added back. So we subtract. I go to note 2. Best Way Limited acquired new plants during the year at a cost of 3.6. So that one doesn't affect our operating activities. Let's go to additional information number 3. Depreciation charged on property, plant, and equipment during the year was, that one is given. Depreciation is provided, which is 10 what? 1098. So that one, remember that it was included in the cost of sales. So depreciation is an expense, meaning that it was deducted. So we add back. Then now we need to check for what? We need to check for the amortization. Amortization. So what is amortized? We need to check for amortization if it's present, that is. If it's not present, we check for loss on disposal, and also we check for other items which might have been available to be adjusted against the profit before tax. So if you go to additional information number 4, intangible assets were amortized during the year, and amortization charged to the profit and loss amounted to 1080. There is amortization charged to what? Charged to profit and loss amounted to 1080. So that is another expense which was deducted. You add. So meaning there is no loss on disposal. There is no loss. And put a dash, or you can clear. But since now maybe you are writing, you just put a dash. Then after that, embark on your income statement. You see, under the profit before tax, embark on that, the income statement provided. Under that profit before tax, go backwards. Under this income statement given here, go backwards. Other than revenue, cost of sales. Other than revenue, cost of sales given. Other than revenue, and the cost of sales. Any other item which is above the profit before tax must be adjusted here. The first one is other operating incomes, which is government grants. Government grants, other than revenue and cost of sales. And maybe if you have admin expenses, if you have administrative expenses, and the distribution expenses, if they are available, distribution expenses. Other than these four, another thing which is above the profit before tax, adjust here. Adjust against your profit before tax. That is 1,500. Remember, it was added, we subtract, we deduct. The next one is, remember that there is other operating incomes. Operating incomes are these. So we don't adjust operating expenses. Yes, they are talking about other operating expenses. These are operating expenses, and they are mentioning about others. You don't adjust operating expenses against your profit before tax. What we are adjusting here is the non-operating ones, the non-cash flow, the non-operating incomes and expenses. So the next one is only finance cost, which is remaining there. Finance cost is 1410. It was deducted, you add. So up to that point, I can say we have 1098 plus 1080 minus 1090 minus 1050 plus 1410. This is 10980, not 1090. 10980, because it was 10 point something, 10 points. The depreciation was 10 points. It was 10.98. So it will be 10980 in thousands. 10980, yes. So 10980 plus 1080 minus 1090 minus 1500 plus 1410. So this is 10,880. This is 10,800 and what? 880. So that one you add. You add to your profit before tax. So plus 16,780. So I'm getting 27,660. That is now your cash flow before changes in working capital. Cash flow before what? Before changes in what? Before changes in working capital. Before the changes in working capital. Then I will come and mention changes in working capital. Changes in working what? Changes in working capital. Here now for the changes in working capital, you check increase or decrease in your current assets or current liabilities, but not all current assets and current liabilities. For current assets, mostly we check for inventory, receivables. If there's prepayments, also you check for that. For the current liabilities, you check for the payables. The increase or decrease in what? Payables. If we start with inventory, now you are considering the balance given as at the end of 2023 and 2024. So you compare that way. The balance is given here to the 2024. So your inventory, was it an increase or decrease? So this one, you compare with this. I can see there is an increase. You talk about increase in what? In inventory. So the increase is 26. The increase there is 24,890 to 28,600. So 28,600 minus 24,890. So that is 37 what? 37.10. So what happens in terms of cash flow? You know, we're talking about cash flow. When there's an increase in your stock, there's money out. There's cash out. All right. Next is what about the receivables? Also, there is an increase from 14,160 to 18,460. So the increase in the receivables, increase in trade receivables. So the increase in trade receivables, that is 18,460 minus 14,160. That is 4,300. Your debtors, remember that trade receivables is all about the debtors. Your debtors have increased. What does it mean? You are giving them more money. So there's money out. So that is money out. You deduct. I need to confirm if you are seeing everything from the other end. I think that is okay. All right. Then we go to the current liabilities. We go to the current what? Current liabilities. So for the current liabilities, we check for payables. So payables, I can see here the payables from 2023 to 2024. Also, there's an increase from 17,540 to 22,400. Increase in payables. Increase in trade payables. Increase in trade payables. So the increase is 22,400 minus 17,540. So that is 48,60. 48 what? 48,60. 48,60. 48,60. So we can get a total for this. We can get a total for this. So that is but now increase in payables, I don't know why I've deducted. I need to explain because it's supposed to be an addition. Increase in trade payables. Payables are creditors. Your creditors are increasing. Your creditors, your liabilities are increasing, meaning that you are doing what? You are buying without paying. That is why your liabilities are increasing. So that is not money out. That is an addition. Your liabilities are increasing. There is no money out. It's an addition. So this is 31 what? 3150. So you deduct. It's a negative. You deduct from. So 27,660 minus 3150. So we get here 24,510. So now we need to adjust 2 items before we finish. We finish the operating activities. The cash flow from operating activities, we need to consider 2 items here. We need to consider 2 things here. So the next thing you deduct after considering your working capital items, the next thing you deduct here is all about tax, less the tax paid. And also you deduct what? The interest. Interest paid. So for tax, we have to do our working one. We have to do working one. So So tax. So you consider your current and deferred tax. You consider both the current and deferred tax. So we have deferred tax and current tax. So for tax, so deferred and the current tax. So you start with the balance brought down. So you look at the balance for deferred, balance brought down as at 2023, which is given as 1620. That is deferred. You add with current for 2023. The current tax is 5550. This is a deferred tax, current tax. Balance is brought down. So 1620 plus 5550. That is 71 what? 7170. After that, now you add the one paid for the year. Income tax for the year from the income statement. Income tax for the year. Income tax for the year. That is P&L. You look at your P&L, your income statement. There's that income tax expense of 53 what? 5310. So we have 0, we have 8, we have 4, we have 12. Skip one line, say balance carry down. So deferred tax as at 2024, deferred tax as at 2024, deferred tax as at 2024 is 3840, and the current tax as at 2024 is 53 what? 5370. So that is the balances as at the end. So 3840 plus 53 what? 70. That is 92 what? 9210. So why did it decline from 12 for 80? That is what we were supposed to pay, to 9210 at the end. So they paid a tax of. So here we have a balance of tax paid. So 12 for 80 minus 9210. So they paid a tax of 3270. They paid a tax of 32 what? 3270. Then the interest we deduct is the one which we added back here, 1410. The one we added there, 1410. So if I take my 24,510 minus 3270 minus 1410, I will be able to get 19,830. 19,800 and what? 30. That is now net cash flow. Net cash flow from where? From operating activities. From operating activities. Net cash flow from operating activities. We go to investing activities. We move to investing activities. We move to the investing activities. So for the investing activities here, now we are going to check for the change in size and the composition. Change in size and composition of the non-current assets. Like now when we have some assets disposed, if we have right now property, plant and equipment disposed, what are we receiving? If we are acquiring assets, what have we received? So the change in size and composition of non-current assets under investing. So the first thing you do, there's our working number 2 we have to do. That is for the property, plant and equipment, to check if there is acquisition or disposal of any fixed asset. So property, plant and equipment. Property, plant and equipment. Property, plant and equipment. The property. So we start with the balance brought down. So the balance brought down is the balance given as per the statement of financial position. as per the statement of financial position, which is 74,900. So meaning that if I have picked, but I have picked 74,900 from the statement of what? From my statement of financial position, implying that this is a net book value. The balances in the statement of financial position are stated at what? At book value. They are stated at book value. They are obviously stated at book value. So what we do, anything now we will be adjusting. If it concerns fixed assets, it has to be stated at book value, and another maybe adjustments now which will follow. So if we go back to our question, in note 1, there is this aspect of a certain what? A certain motor vehicle which was disposed, but it was having a cost of 5.26 and accumulated depreciation of 2.33. So that one we have to deduct. That one we have to do what? We have to minus. So we say value of what? Disposed motor vehicle. And since now we started with net book value, the next value for this, it has to be at what? It has to be stated at net book value, meaning that I have to take my cost, which is 5260, minus accumulated depreciation of 2330. So the value of that will be 5260 minus 2330. That is 2930. 2930. Then after that, there is note 2. There is a new plant acquired at a cost of 3.6 from a financing company. An arrangement was made at the date of acquisition for the liability for the plant to be settled by Bestway Limited issuing at par 10% loan note. Yes, so payments, it was done through loan notes. So the value by which the loan note exceeded the liability for the plant was received from the financing company in cash. So what am I going to consider here? Remember now, there is a plant which has been done what? Acquired. Through what? Through a 10% loan. So I will say 10% loan note. Here we have new plant. So that one is 3,600. That one we add. That one is added because it was acquired, not disposed. It was acquired, not disposed. Next is all about additional information number 3, where we have depreciation. Depreciation is all about 10,980. So that one reduces the value of the asset. You minus. Number 4 is all about intangible assets. Number 5 is all about bonus. But if you come back to other comprehensive incomes, there is gain on property revaluation. So there is revaluation gain. You have to consider. Remember, property is part of this. Gain, revaluation gain. That revaluation gain from the statement of profit and loss under other comprehensive incomes is 51. So up to that point we have, so 74,900 minus 29,30 plus 3,600 minus 10,980 plus 5,100. That is 69,690. And also I will skip one line. I say balance carried down. So the balance carried down given here, so that I look for the balancing figure. The balance carried down as per the end of 2024 is 92,600. 92,600, which is more. 92,600. What does it mean? Remember that there's an increase. That one means that there's an acquisition which has been done. If it's a reduction, it's a disposal. Acquisition of property, plant, and equipment. acquisition, the increase. There's an acquisition. So the balancing figure is 22, 910. 92, that is 22, 910, 910. So that is working 2, eh? So I'd come here and say acquisition of property, plant, and equipment, working 2. That is working 2. Here we have shillings in thousands. And also we have shillings in thousands. So it's 22, 910. So acquisition of property, plant, and equipment. Acquisition of property, plant, and equipment. Meaning that there's cash outflow. There's money out. There's money out. That is the first thing I've done. Again, I go back to my question. Additional information number 1. Remember there was that motor vehicle which was disposed and we received money. So there's proceeds. There's proceeds from disposal of motor vehicle. Proceeds from disposal of what? Motor vehicle. From disposal of motor vehicle. Proceeds from disposal of motor vehicle, 40/20. So that is an addition. There's money in. There's money in. Then if I go back again to my question, there's this aspect of intangible assets. There's this aspect of intangible assets, which was done what? Which was amortized, yes. But now we need to analyze and check, did they acquire any other intangible assets or disposed? So I will look at what? Intangible assets. So working number 3. So working 3. Let's analyze intangible assets. Because already I had analyzed the words. Property, plant, and equipment. Now next is intangible assets. So balance brought down. Balance brought down as per 2023 is all about 12,300. And there's amortization, additional information. There's an amortization. There's an amortization. So the amortization is 1080. That is according to the question. That is additional information. So remember the amortization, meaning that the intangible asset lost some value. So up to that point, 12,300 minus 1080. That is 11 words. 11 to 20. The balance carried down is for intangible as of 2024, 13,500. That is 13,500. So meaning that there is an increase, that is an acquisition cash flow. This is an acquisition which is done. There's an increase from 11 to 13. 13,500 minus 11 to 20. That is 22 words. 2280. So that is an acquisition. An acquisition. There is an acquisition done. So I would come here and say acquisition of what? Acquisition of intangible assets. Working 3. Acquisition of intangible assets. That is 22 words. 2280. 2280. Last but not least, for investing, Last but not least for investing. So remember that there was this government grants. There's this what we call government what? Government grants. There's this what we call government grants. So we need to check if we received any government grants. So there's this government grants. You know what's a grant? What's a grant? So here I will come and do working for concerning government grants. So for this one, I will just open a T account. So if you look at your liabilities, you have the non-current, you have the government grants under the non-current liabilities under the current. So here you talk about these balances as of 2023. These balances as of 2023. So the balances as of 2023, you look at non-current liabilities. I will say NSL. Then I look at current liabilities as per 2023, end of 2023. The 2023. So as per 2023, this one is 63. Those are like balances brought down. And we have 16. According to the equation is 1620. Then we have other balances here, end of 2024. 2024 end. So under non-current liabilities and for the current liabilities. So according to the equation, it's 4,800 and 1,200 and 1,200. But there was under the income statement, there was government grants. If you look at your income statement, the statement of profit or loss, other operating incomes. So here you need to add this one under income statement. There was 1,500. So my balance will be the balance to cash flow. On the other side, the balance to cash flow. So cash flow statement. So the cash flow statement income. So the cash flow statement income, the balancing figure that is will be. So 6,300 plus 1,620 plus 1,500. So the total here is 9,420. We have here 9,420. So minus 6,000. So that is 2420. So that is what you record up there under investing. As the government grant done what? Received. As the government grants received. Government grants done what? Received. 24 what? 2420. Up to that point, we are done with what? Investing activities. So net cash flow from where? Investing activities. From investing activities. So that is remember for the acquisition of intangible assets, this is money out. So you get 17,750. 17,750. Remember here we have A, we have B. Now we go to C, financing activities. Financing activity, and that is a cash flow from financing activities. So the cash flow from financing what? Activities. Even this one, it was supposed to be cash flow from investing activities. Cash flow from investing what? Investing activities. And that is okay. So remember that for the government grants received, this is what from working for. Is a working here, working for. You understand, eh? I must write everything. Now we continue with cash flow from financing what? Financing activities. Cash flow from financing activities. So an organization can be financed through equity or debt. So I will be looking at my equity and liabilities. And students of CPA, I said earlier when we started that we have been doing online classes. We have been doing online classes from time to time. So right now, today evening, we have financial reporting and analysis class from 8 to 10. So if you want to join those sessions, I have shared my number under the chat. We can talk on the way forward. That is my contact. So I have shared my number. Whoever would like to join can join. So let's finish financing. So I've said an organization can be financed through debt or equity. So I will start by looking at my equity. So under equity, we have ordinary share capital and share premium. So what we do, you see note 2. Yeah, note 2 now comes in. Note 2 is very key. Bestway Limited acquired new plants during the year. So note 2 and note 5, yeah, they are very key. Note 2 and note 5. Bestway Limited acquired new plants during the year ended 31st December 2024 at a cost of 3.6 million from a financing company. An arrangement was made at the date of acquisition for the liability for the plant to be settled by Bestway Limited issuing at 10% loan note dated 2028 to the finance company. So you will pay by giving a loan note. So the value by which the loan note exceeded the liability. So that loan note, the value of the loan note issued exceeded the liability was paying for when he was acquiring that plant. We have said the loan note exceeded the liability for the plant was received from the finance company in cash. So the balance will be received from the financing company in cash. The note 5, during the year ended 31st December 2024, Bestway made a bonus issue of ordinary shares of 1 new share for every 10 shares held, utilizing what? The share premium account. So let's analyze. Let's do analysis for premium and our capital for us to see if there is any issue of shares or they just received something. So let's do an analysis. So here we'll talk about share premium. Just say SP. I'll do a T account, a small T account. Share premium. So the balance brought down Remember there was a bonus which was issued. You're tracing what? The share premium. It's a bonus. A bonus is all about whereby the company decides that what I'm going to do, I'm giving out. I'm giving you an option. Not I'm giving you an option. An option is when we talk about right issue. I'm giving out shares for free. And that is at no consideration based on a certain proportion. Like now here it was 1 for every 10 you have. You are given 1 for every 10 shares you have. As at which period? They said as at 31st December 2024. Those are the shares from the previous year. Those are the shares from the previous year. And the shares from the previous year, that is 2023. That is 2023. Because now the shares from 2023 are the one towards to bring in the year 20. They are the one present in the year 2024. They are 12,000. They are 12,000, of which per share is going at 10. So if we do that, it means that the number of shares they issued to raise 12,000 is 1,200. So they are saying that we are giving you a bonus of 1 share for every 10 you are holding. So how many shares were given out through bonus? How many shares were given out through bonus? How many shares? So it's all about 1,200 divided by 10. 1,200 divided by 10, which is 120. But now to get the value, remember per share is 10. The per value is 10. So we'll come back to the 1,200. But for us to issue this, we utilized what? We were utilizing what we call the share premium. That is why I've started with share premium. So here, balance brought down is 2,100. Balance carried down is 21. Balance carried down here is, balance carried down there is 27. Then now for them to issue this bonus worth 1,200, they utilize the share premium, meaning that I will do what? I will debit here. I have to do a debit. That is bonus. They were utilizing this bonus issue. So that is 1,200. So here now, the balancing here, they say that the cash flow, that is now a cash issue. So 2,100. So this one will be 39. So 39. So the balancing figure, which is a cash flow, which is a cash issue, is all about 1,800. 1,800. All right, we continue. And we look at our ordinary share capital. So remember that we are doing published financial statements. These are cash flow statement. April 2025. This is April 2025. Question 5. So now we go to the ordinary share capital. So again, we do a T account. So the ordinary share capital balance brought down is 12,000. Balance brought down is 12,000 according to the question. Balance carried down according to my equation there. Balance carried down is 15,000. Then remember that they were issuing shares. They were issuing shares, but you tracing what? They were tracing the share premium. That is why I debited here 1,200. So I have to credit this bonus issue. So that bonus issue will be 1,200. So it's credited there. They issued shares through bonus. So So we have 15,000. 15,000. Also, a cash issue will be a cash issue. It will be obvious 1,800 again. So that is 1,800. Now I think you are going to understand this aspect of note what. That is why I said there's this aspect of note 2 and note 3. Remember they said that they were acquiring what? They were acquiring a plant, and this company, yes, decided to issue what? 10% what? Loan note. 10% loan note. It's issuing a loan note. But now this liability that's issued is in excess. It's in excess of what he was paying for. It's in excess of the value of that plant. It's in excess of that value of the plant. He was supposed to pay 36. 36 is more. 36 is more than the loan note he gave out. That is why they said for the plan which the loan note exceeded the liability for the plant was received from the finance company in what? In cash. So we need to check now the cash issue. So we do the last part. So here we have a cash issue from premium. Remember, from premium it was 18. From our ordinary share capital is also 18. That one totals to the total of 36. That one is totaling to 3,600. 3,600. If you look at your loan note, the balance at the end, balance carried down is 16 what? 16,500. The balance at the end is 16 what? 16,500. So less this plant, the new plant, which was done what? Which was acquired through this is less 36. So if you less 36, the new plant, and also you less the balance brought down. Remember there was a balance brought down of what? 10,500. If you do that, you will have an issue. You will have an issue. So that is why they said this value was exceeding the liability. So that the balance they received from the company in what? In cash. So 16,500 minus 3,600 minus 10,500. So that is the 2,400. 2,400. That was the only difficult part in this question. So now, what would I record under financing? What am I going to record? Because we have done almost everything in terms of the workings for this financing. So the first thing is all about the issue. What the issue there? In terms of already we have this cash flow issue of 18 and this one under capital. From premium we have 1,800 and for ordinary share capital we have 1,800. That one totals to what? 3,600. Issue of new ordinary shares. Issue of new ordinary shares, and I can say and what? Issue of new ordinary share, that is issue of new ordinary and share premium, or at share premium, at premium, or and I can say anyway. So that is the 36. You understand where the 36 is coming from? 18 plus 1,800, the two. All right. The next thing is what we have done here. Determination of this. So this one will be issue of 10% loan note. Because now they were receiving the balance. Remember they settled this liability through issue of a 10% loan note. But this liability they are paying on acquiring this plant exceeded the value of that plant. So they were receiving the balance in cash. So this company will be receiving this 2,400. So we say issue of 10%, issue of 10% loan note. So we have 24. That is 24. All right. So if I look at my equity, we have already considered all the share capital, share premium. Remember, revaluation of 51 was added when we were doing property, plant, and equipment. That was again under the property, plant, and equipment, the 5,100. So the only thing remaining here to look at is retained earnings. Retained earnings. So that we check if they did what? If they paid some dividends. So for retained earnings, we are checking if they paid what? Some dividends. So retained earnings. So we do our working on retained earnings. So the balance brought down for the retained earnings is 71,960. 71,960. Then now you look at your income statement, the profit for the year. Add the profit for the year from your income statement. So if I go to my income statement, profit for the year, that is profit after tax, is 11,470. That is 11,470. The profit up to that point to be retained, so 71,960 plus 11,470. So the total is 83,430. So, but now my balance carried down, the balance carried down of the retained earnings, that is as at the end of 2024, is 76,500 what? 76,530. Why is it reducing? They paid dividends. Dividends paid. So dividend paid. So dividends paid off. So the difference. 6,900. 6,900. 6,900. Dividend paid. Dividend paid. 6,900. That is cash out. Aye. So net cash flow from financing activities. So 3,600 plus 2,400 minus 6,900. So that is a net cash flow. Here is what? 900. So this is C. So this is my net cash flow from financing activities. Net cash flow from financing activities. So net cash flow from financing activities. So net cash flow from financing activities, just this 900. GC. Remember this one was A. From operating. From investing is B. From financing is C. So then now we get the total. The cash flow for the year. The cash flow for the year. So now I will take 19,830 minus 17,750 minus 900. 19,830 minus 17,750 minus 900. That is 11 what? 1180. Then now finally you will be able to add cash and cash equivalents. you will add cash and cash equivalent at start. At start, so that you get what? Cash and cash equivalent at end. So at start is for 2023. If you go back to your question, under current what? Current assets. Cash and cash equivalent as of 2023 is what? 10, 20. As of 2024 is 2200. So yeah, we are checking one thing. You have cash and cash equivalent at start of 1020. For the year is 11 what? 1180. So if you take your 1020, you add to 11 what? 1180. Are you getting? 2020. But cash flow, you can mark for yourself because it has to balance automatically. Yes, it's balancing. So meaning that here I have 10, 20, and this one is 2200. And that is how you were supposed to do this question for us sitting. A question of 20 marks. April 2025, question 5B. It was having how many marks? 16. It was having 16 marks. It was carrying 16 marks. And they were marking this way. So this is a mark 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So out of the 20, they needed any 16. Any 16, they multiply by 1. You get your 16 marks. Any what? Any 16, they multiply by 1. You get your 16 marks. Then there was part A, whereby they were asking, this one was simple, 4 marks. With reference to IS-12, income taxes, describe the basis of measurements for current tax liabilities and current tax liabilities. Current tax, describe the basis for measurement of current tax liabilities and current tax. Describe the basis of measurements of current tax liabilities and the deferred, and the deferred tax liabilities. So you could have said that for the current tax liabilities, is that the current tax liabilities, for the current and the prior period should be measured at an amount expected to be paid to the tax authorities using the tax rates that have been enacted by the end of the reporting period. So it's just tax to be paid for the current period. So for the current and prior periods, you do what? You measure at the amount which is supposed to be paid. The amount which is supposed to be paid to the taxation authorities, like now KRA. The amount you are supposed to pay to KRA using the tax rates that have been enacted by the end of the reporting period. By the end of the reporting period. So in simple terms, you say that tax to be paid for the current period. Tax to be paid for the current period. So for the deferred tax liabilities, deferred tax liabilities shall be measured at the tax rate that are expected to apply to the period when the liability is settled. That is the main thing. To the period when what? To the period when the liability is is settled. To the period when the liability is settled. Based on tax rates that have been enacted by the end of the reporting period. So the main thing here, apply So measured at the tax rate that are expected to apply to the period when the liabilities done what? The liabilities settled. Based on the tax rates that have been enacted by the end of the reporting period. I think I've answered those 4 marks also. Those are theory. So, students of CPA, you can join my online classes. Like today we have a FR from 8 to 10. We have financial reporting and analysis class from 8 to 10. Use this number well. So you can WhatsApp, you can call. We agree on the way forward. On the way you can be able to do what? On the way you can be able to join my online classes. So thank you for attending today's session. We'll be doing, for the last sitting paper, I will be able to do all the questions, all the 5 questions. I remember we did for, we tackled the consolidation. So we have done the cash flow. So maybe next time I do the one for financial analysis. The one for financial analysis. Then we remain with one. We remain with one, which was, I think, concerns what? Because we have done question 5. So next, if I do the one for financial analysis, which is question 2. Yes, using vertical analysis and horizontal analysis. So we could have done question 2. So next I will do question 2. So already we have done question 3. I tackled consolidation. So we will be remaining only with question 4. We'll be remaining with question 4 for the retirement schemes. For the retirement schemes, and the one for financial instruments. So share this video to other platforms. I know you have colleagues who are doing CPA. Some of them, they are not aware that I do some free sessions, some of the live free sessions. So you can share with them, to the relevant groups. And never forget to subscribe to this channel and open the notification bell so that once I'm doing a live session, you are notified. I thank you for attending. See you today in the evening if you will be coming in for the online classes. So use this number well. All right.